Well, welcome everyone. Thank you for joining us, whether it's good morning or good afternoon, wherever you are, to our Managing Your Church is Balance Sheet presented by New Covenant Trust, the Presbyterian Foundation, and the Presbyterian Investment and Loan Program. My name is Claire Lewis, and I serve as the Senior Vice President of Sales and Marketing for the Presbyterian Investment and Loan Program. And I've joined here with some great colleagues that are going to share some information with you today. We want to honor your time and allow as much time as possible at the end for questions. So we'll go ahead and get started. But why don't we start with a word of prayer? Please join me. Gracious and loving God, we thank you for the opportunity to use technology to connect and carry out our work that you have called us to do. You've called this group to be stewards and caretakers of all that you have entrusted to us. Help us to use your gifts wisely and teach us to share them generously. Send the Holy Spirit to work through us, bringing your message to those we serve. May our faithful stewardship be a witness to the love of Jesus Christ in our lives. We pray with grateful hearts in the name of Jesus Christ. Amen. And again, welcome. Before we get started, just some quick technical notes. Thank you to everyone for submitting your questions when you registered. We'll try and get to as many as those as possible at the end, or perhaps some of them will be answered during our presentations. But please feel free, if a question comes to you during the presentations, to use the Q&A function that you'll find located at the bottom of your Zoom taskbar. We have disabled chat due to the number of people on, just to keep us moving. So the chat function will not be activated for our presentation time. So on that note, our first presenter is Robert Hay, Jr. Robert is a Senior Ministry Relations Officer serving the Southeast from the Presbyterian Foundation. He's a ruling elder and lives in Atlanta with his wife, the Reverend Morgan Hay, and their two middle-aged children, middle school age children. Wow, that was a mouthful. Sorry, Robert. So please go ahead.
Yes, I'm middle-aged. My children are not, so they're in middle school. So thank you. I'm going to try and share my screen and make sure that gets up on the screen before we jump start. Let's see. There we go. I hope you can see that up. And good. So yes, as Claire said, I'm Robert Hay. I live in Atlanta and serve the Southeast as Ministry Relations Officer from the Presbyterian Foundation. I'm a former CFO and served a couple of nonprofits before joining the foundation 12 years ago. And my background is I have a Master of Public Administration with a nonprofit management concentration. And so I come at things in my work with the church kind of with that financial background, and have helped many churches look at reports, look at finances, and figure out the best way to do their reporting. My role today is to give a basic overview of a balance sheet. So we're going to take a few minutes to look at a balance sheet and orient ourselves to it. In the church, we often talk about cash. Most of us know about cash, and that's the concept that money makes the world go round. Unfortunately, we often let money control the church, and most churches really only pay attention to their cash and ignore the two other main types of asset types. So we're all comfortable here with cash and maybe how to report in and out, profit and loss. But we oftentimes miss some opportunities with a couple of other asset types. So one of those is investments, and we would talk about endowments and reserves. And I often hear well-meaning church members say something like, but we can't invest church money because that is being risky with money, and we have to be good stewards of the money. Well, I believe that being good stewards means maximizing what you have been given for ministry purposes. And we're not called to bury our talents, but instead we're called to use them and multiply them do more good. So I believe good stewardship actually means prudently taking advantage of the different investment vehicles available, from money markets to CDs to term notes to bonds, stocks and equity, and finding a good and prudent approach that balances the appropriate level of risk with a maximum return for ministry. And my colleagues from the New Covenant Trust Company will talk a little bit more about best practices when it comes to investing. But one of the other assets that often gets overlooked is our property. We all know we have property. We have these beautiful buildings, and oftentimes our largest asset in our church is our property. But many of us also begin to think of it as our biggest albatross. But I think we're truly blessed with all the property and buildings that those faithful saints that came before us built for us. We all know that the church is more than the building, but sometimes we forget that. And sometimes the Spirit is calling us to leverage our building to help us be a better church. So my colleagues from the Investment and Loan Program will tell us a little bit more about how a church can do that as well. So those are kind of the asset types we're going to talk about today. When we look at church financial reports, there's really three main church financial reports that every church should have. There's the statement of financial activity, as it is called, or it is more frequently talked about as the profit loss, or P&L. And this is what we're all pretty familiar with reading. Shows the expenses and income for your general operating fund. And then there's the designated funds report. This shows the balances of each designated fund. And then, of course, there's the statement of financial position, which is also known as the balance sheet. And that's what we're going to spend the rest of my time looking at. So it's a snapshot of the church's assets and its liabilities at a specific point in time. Today, I'm really only going to focus on the balance sheet. But if you have questions about the other reports, I will provide some resources at the end of my time that can help you. But let's look at a sample balance sheet. So this is a basic balance sheet for or a statement of financial position for this fictitious church of First Presbyterian Church of somewhere. As I mentioned, this is a snapshot in time, and oftentimes what you see is the most recent period. So in this example, December 31st of 2022, being compared to the same period a year ago, December 31st of 2021. And what we have at the top are the assets. And the assets are all the balances of all of your accounts. And we typically start with the nearest term assets, so cash, and then you move to longer term assets like investments. So you can see we go from checking to savings to investment to endowment on your asset sides. The assets here show you what you have. They don't show you what the restriction or designation is. It just shows you what you have. On the other side, the bottom of the balance sheet is your liabilities and net assets. Liabilities are those debts that you have. In this example, payroll payable or accounts payable. These are things that you owe that in this moment of time, maybe you haven't quite made the payment for yet, but you owe it. And then you have net assets here on the bottom, and the net assets are your fund balances. So in the church, we use what's called fund accounting. And in fund accounting, you have a designated fund for each designation or restriction. So here we've got examples of some pretty basic funds that every church should have. One is the general operating fund, and this is your main church's profit and loss statement. This is how that report connects in here. So if you're running a profit or running a surplus or a deficit, that would show here on the balance sheet. And then another one is unrestricted reserve. This is the amount of all of your assets that is unrestricted. And then we have your designated funds. Typically, we show kind of just one designated funds total, which is the total of all of your designated funds. And that's why you have that separate designated funds report to show the details of those. And then oftentimes you'll have a permanently restricted line on your balance sheet. And this is typically the permanently restricted part of your endowment. So oftentimes maybe the corpus or the beginning balance of your endowment. And it's called a balance sheet because the total of the assets, the top of the report, and the total of the liabilities and net assets, the bottom of the report, those two must balance each other. They must be equal or in balance with each other. So that's where the terminology comes from. So let's look a little bit more at investments on this, this balance sheet. So a common misconception in churches is that investment accounts must be treated like an endowment, that those are the same thing. But investment accounts can be used for reserves that have no restriction or even for designated funds. So, and then the restriction is what's shown down on the fund balances under net assets. And that's what tells you if money should be treated like an endowment or some other type of designated fund. So in this example, you can see that there is $42,000 in a general investment account, and there's $81,000 in a long-term asset and investment account that's called the endowment account. And then if you look down at the bottom under net assets, you can see 75,000 of that is permanently restricted. And so that is the permanently restricted corpus of the endowment. And as you look back up at the top, you put those things together, and that tells you that the endowment has a corpus of 75,000 and currently has an account balance of $81,000. So that's how we put these two pieces of information together to see what's permanently restricted and maybe what the growth of the account is in the investment. And then as you look back at that other investment account, that $42,000, that's not a part of that endowment at all. And in this example, we would say that that is probably a mix of those designated funds of $32,000 that you see, and probably some of the cash that is unrestricted as well. So that's how we put those two pieces of information together. So let's look at this unrestricted piece, right? So you've got the unrestricted or reserve fund. And this is a really important net asset to keep updated. Treasurers really should spend some time making sure this is accurate and then educate session on it and constantly direct their attention to it. In my experience, many sessions incorrectly will look at their savings account balance to see how much reserve they have. And really, you should be looking at the unrestricted reserve or net asset on the bottom to see how much of your cash is not restricted. That's a much more accurate reflection of your reserves. And this is a perfect example of that. So you see there's an unrestricted amount of $60,808 compared to what's in the savings account of $35,450. What that tells us is that some of this other cash here is unrestricted and not designated. And so you've got more unrestricted cash than maybe your savings account shows. So educating sessions about the difference between what's in the account and what is actually on the net assets is an important thing that can help sessions as they move forward. Additionally, each year the general operating fund should be brought back to zero. And any surpluses or deficits for the year should be moved or taken to or from the reserve account. So you can see in this example at the end of 2021, it looks like there was a break-even year. Well, actually what this means is after they finalized the books for 2021, they took from or added to the unrestricted reserve the amount of the surplus or deficit that they had. And that's bringing that general operating fund to zero. And here for 2022, you see there's a operating surplus of $3,800. And as this church would finalize its year-end accounting, they would want to make an accounting entry to move that $3,800 to the reserve fund, which would then increase the unrestricted reserve fund up by that amount. This allows the operating fund to start with a zero balance for the next fiscal year, so that you can track against your budget. And this always allows your church to be able to quickly look at your unrestricted reserve net asset and know what amount you truly have unrestricted. So there's an asset missing here, right? It's that property one, right? So there's that question. What about property? What about buildings and fixtures and other fixed assets? Should we show that on our balance sheet? I get that question quite a lot. And the answer is no. It's not necessary to show property or other fixed assets on your balance sheet for most churches unless you have debt. The purpose for including fixed assets on a balance sheet for taxable entities is that they're required to show the property and those fixed assets on their balance sheet. And taxable entities are also required to show depreciation of those assets. But most churches don't need to do this because we really don't have any plan to leverage our property or to sell it. So it just kind of makes the reports a little bit more confusing if you have it on there and are trying to track depreciation. It's just not necessary for a church to do that unless you have debt on a fixed asset. So if you have debt on a fixed asset, then you absolutely should show that on your balance sheet. So let's see what that might look like. So this is that same First Presbyterian Church of somewhere. And the only difference now is that we are showing them with some debt. So you can see the church has a mortgage from our friends at the Presbyterian Investment and Loan Program. And that's listed there. So at the top under assets, we've now added a fixed asset where we are listing the property and buildings with the appraised value that was part of probably securing the debt. There was an appraisal that would be needed so that you could secure the debt. So putting the appraised value there, and you can see between the 2 years, 2021 and 2022, that value didn't change. There's no need to change that value. It was the value at that time. Again, we don't need to show depreciation. That's not something we're required to do. So, and then you see, if you look down under long-term liabilities, you'll see the mortgage balance listed there. And you can note that at the end of last year, it was $985,000, and now at the end of this year, it is $925,000. So this is one that we probably are going to track and change as we pay down that loan. And then, of course, in order to balance the balance sheet, you would need to track a net asset account, something called, something like building equity fund. And essentially, that's the difference between the appraised value of the property and the balance of the loan. And so you can see as the balance of the loan changed under long-term liabilities, the building equity fund changed in the same amount in the opposite direction. So as we paid down the loan, we added to our building equity fund. That really is just the accounting piece to make sure that we stay in balance. There really is no need to update the mortgage payable each month, but I would recommend that you update it at least annually as you are paying down the loan. Many churches would do it quarterly. I think that's fine as well. There's no need to really do it monthly, but you really do need to, at least annually and find some routine that fits for you. And then, of course, when you've paid the mortgage off, I think it's then time to remove all this from your balance sheet. So again, here's just a quick side-by-side of the two. You can see there's very little difference between the two, other than adding those fixed assets and those long-term liabilities and that building equity fund. And when you don't have debt, there's no need to put the fixed asset on your balance sheet. Again, if you have more questions about reports, we did a webinar back in the fall, and you can find it at this web address, presbyterianfoundation.org/day-of-learning. And it's a wonderful webinar where we walk through all of these reports and some best practices for church reports. If you go to that link, it's the first session listed. It's called Understanding Budgets and Reports. And there's also some examples of reports on that same page. And then here are 3 books I would encourage you to have. Each church, I think, should buy all 3 of these books, and it should just be handed to the treasurer as resources for your treasurer. These are by Ed Breeden. Ed Breeden is a PCUSA pastor who has served as a treasurer of his presbytery. And these books are really simple to follow and a good understanding of how a church, particularly a Presbyterian church, can and should be managing its finances. Couple more resources for you. There's a financial review checklist. If you're looking for a financial review, you can go to the PCUSA website and search for financial review, and there's a good checklist there. Your Presbyterian Synod staff are really good resources for you when you have financial questions. We also have a resource called the Church Financial Leadership Academy. This is a free resource put out by the Presbyterian Foundation. You do need an access code, which is PCUSA, but it has short 5 to 8 minute videos on a variety of financial topics and could be a great place for you to learn in little snippets about different financial items. And then Stewardship Navigator is another wonderful resource, which is a good toolbox for all the stewardship resources you may need. And then, of course, your best resource is your Regional Ministry Relations Officer. We can help you with a variety of things from finances to investments to stewardship. And if we don't know the answer, we will help you find the resource that does. So please, I would encourage you to get to know your Regional Ministry Relations Officer. We are here to serve you and happy to do it. So that really wraps up my portion of today. I'll hand it back over to Claire, but please feel free to reach out to me or any of the ministry relations officers if you have any follow-up questions or need anything. Thank you very much.
Thank you, Robert. That was very insightful and a good grounding as we look a little deeper into the liability side of the balance sheet first. And so Jim and I are going to walk you through that. Jim will start. Jim is the president and CEO of our Presbyterian Investment Loan Program. He spent 17 years in commercial banking prior to joining our program. Jim joined the program 24 years ago as the vice president and COO, becoming the senior vice president and CEO 5 years later. And he's had his current role as president and CEO for the past 9 years. So Jim.
Thank you, Claire. Good afternoon and good morning to those further west. We'll be focusing on the liability side of the balance sheet, exploring factors to consider if your church is looking at the possibility of taking on new debt and steps to take when managing existing debt. First, let's look at new debt. What is the right type of debt? You want to match the type of debt to the purpose of the loan. So if you're doing a major renovation project, an expansion of some sort, if you're doing a large maintenance project, redoing the roof, HVAC system, then you want more of a traditional loan. That's got a long-term benefit to that project. So you want to match that to a longer-term loan, or can match it to a longer-term loan if needed. If you've got a smaller project, a small maintenance project, something that you might have to redo. You're doing this project next year. You might have another maintenance project. You want a shorter term loan, something that really you can pay off in about 12 months, because you might have to have another type of maintenance project next year. Or you could use a line of credit for that process. Either way, you want to make sure that it's short term, 12 months or less. Another time that you might want to look at a line of credit would be if you've got fluctuations in your cash flow. So if you've got fluctuations, say you've got a summer shortage, and then you've got overages maybe in September when everyone comes back to church or at the end of the year, then you can draw on it when needed, pay it down. But the important part on a line of credit, it's for short-term exposure, short-term lending. So you want to make sure that you pay that down at least every 12 months. You don't want to get into a cycle where you draw on the line of credit, you pay it down some, but you leave this residual balance that starts to balloon over the years. You want to avoid that type of situation. You also want to look at what have you done? How have you planned for this debt? Are you managing to the debt service, or are you managing to the debt? That is, are you planning on what you need to do to make those monthly payments? Or are you planning on how you're going to eventually just pay off this entire loan? And in fact, it really needs to be a balance of both. You need to manage the debt service to what your regular cash flow is, but you want to make sure that you look at when are you going to pay off this loan, how and when. Most of the loans have a longer amortization, like 20 years or so, but you want to make sure that you pay it off as quickly as you can, quite frankly, to make sure that you're ready for whatever the next project, mission, ministry, whatever you might want to do. And probably the biggest question, how much can you handle? How much debt can you handle? So first, it's helpful to look at the financial position of your church. Are you having deficits? Are you having surpluses? Are these consistent one way or the other? Are you having significant deficits, or is it one that maybe is an outlier and generally you're breaking even? You want to check to see what that is. If you are having surpluses, are they consistent or do they fluctuate greatly? Get an idea of what that looks like. Is your giving strong, and is it consistent? Is your giving equal to or in balance with the expenses that your church has? Or are you relying on other sources of revenue, such as rental income, bequests, anything else that helps support that? So it's good to see where you are with the giving per giving unit. Also, is it consistent, or does it tend to fluctuate year after year? Do you have reserves in place? Is there money that is set aside? And is it in the proper amount to cover unexpected costs, unexpected events? Is it at a good level for the unexpected? One last thing about the reserves is, are you drawing on those reserves to help balance the operating budget? And if you are drawing on those, are you drawing on them at a sustainable rate? Are your reserves keeping up with inflation? If not, have you adjusted your budget to avoid a declining endowment balance? Some projects are urgent, and you've got to do them right away. Many projects are not urgent. Look at your financial position and see, is this the right time to do a project? Is it the right time to get additional debt? Or can we wait? Can we wait and get a stronger financial foundation before taking that step? So you've decided, yes, this is the right time to do the project, right time that you, if you have to, can borrow money. So what are the resources that you might have to help support that project? First, you can look at the surpluses. Are they recurring and are they consistent? If so, you can use some of those funds in the first year in construction, or you can look at those to help in the ongoing debt service on the loan. Reserves, not just your reserves, but as Robert had spoken about earlier, are they unrestricted reserves? And are they unrestricted reserves over and above the amount that you feel comfortable setting aside for those unexpected costs? So you want to make sure that's all into consideration and just take, in essence, what I would call excess unrestricted reserves that are available for the project. And big decision on any large building project, are you going to have a capital campaign? It's important to know what you might be able to expect if you have a capital campaign, and also what you might be giving up if you choose not to have a capital campaign. So what we see in capital campaigns is, if you have an outside professional consultant help you with the campaign, we generally see 2 to 2.5 times what your operating pledges are. Just the pledges, not the other revenue. 2 to 2.5 times is a good to very good capital campaign. Also, if you choose not to have a professional consultant, we see a fairly significant decrease in the results. And normally we see somewhere between 1 and 1.5 times of operating pledges. And that's for a good to very good capital campaign. You can see there is quite the difference there. In most situations, almost every situation, it generally is you will get more from a professional capital campaign than it would cost to have that. That variance is greater than the cost. Oftentimes, it's a significant positive difference. So let's take a look at an example. We've got a capital campaign estimates here. Your pledging budget is $300,000. You could have 2 times that, which is a pretty good capital campaign at 600,000. 2.5 times, very good, 750,000. Anything over 2.5 times your pledged budget is really considered an excellent capital campaign. And we certainly have seen those that are 3 times and even more. One thing to remember when looking at this is that this is for the first capital campaign. The second or subsequent capital campaign, you normally see lower results. A few other items to consider when thinking about a capital campaign, and particularly important to your cash flow projections, is pledges don't come in evenly over the 3 years. Typically, we see about 40%, sometimes even more than that in the first year, and then 30% in years 2 and 3. That's important to figure into the overall cash flow because it helps you determine not only the cash flow, but also how much money you might need to borrow based upon the cash flow income. Don't commingle your capital campaign funds with anything else. Never do that. You lose the ability to properly manage your receipts and your expenses. And you want to make sure that you're absolutely clear on what those are, because you want to be certain that the information that you are relaying to the leadership of the church and the congregation is not only transparent, but very clear to track. Capital campaign funds that will be used relatively soon, and we're saying within 2 or 3 years, should not be invested in areas where the principal value is at risk and may fluctuate. You have decided how much and planned for how much that capital campaign is going to be able to supply as a resource for your project. You've already set that. You're committed to that. You can't be in a situation where that fluctuates and the amount of money that you now have to go to the project from your capital campaign is negatively impacted by market fluctuations. Don't waste the opportunity to run a capital campaign. It is the best time, whether it is a situation where the project is an urgent one, you're replacing the roof, your boiler has gone out and it's January, so it's either urgent or it's an exciting time for a new project. You're doing something new, either a major renovation in the church, you're changing the space to have a new type of mission or ministry in it. It's an exciting time. This is a time that you can go forward to the congregation and have them participate in that and commit in a financial way. It helps you to avoid using your reserves, which may be used for something in the future. It also helps you reduce the amount that you might need to borrow. So it saves money as well. Likewise, it also is a way of getting the congregation not only involved more in the project overall, but if you run the capital campaign or start having the quiet part of a capital campaign discussing it, you can also judge the level of support that the congregation has for the project that you're looking to do. Consider the length of the time since your last capital campaign. If you've had a capital campaign recently, then you may want to say, well, let's wait a little bit until we do this next project. Or if it's something that either you have to do now or want to do now, you need to take that into consideration when setting goals for what your capital campaign will be, knowing that you just finished one 2 years ago. Set expectations with the congregation. It's critically important to be transparent with the congregation as a whole. So make sure that they know what it's going to take, what the commitment is going to be to do this project. Are you going to do 1 capital campaign, 2 capital campaigns, whatever that might be? Make sure they know that up front. And also, it's good to have the plan on how long is it going to take? How much money will you need to borrow? How long will it be before you pay off that loan? Make sure they know this all up front so you get that buy-in at the front and you don't have a surprise congregation going forward.
So we've analyzed how much debt we can handle. Now we also want to consider how long is that church going to have this liability on our balance sheet. So first, we want to keep in mind that church debt is not the same as your home mortgage. Typically, that's an expense that we manage and maintain for 20, 25 years in our personal expenses. But the goal for a church should be to retire that debt as soon as possible. So, the congregation can move on with different mission or other projects that they need to complete. We also don't recommend that you move the debt service, and debt service is just another word for those loan payments you make every month, into the operating budget until that debt service is approximately 10 to 13% of your operating budget. So if it's not in your operating budget, most likely those payments are coming from those capital campaigns that Jim was referring to. So we need to consider how many of those consecutive capital campaigns is it going to take to retire that debt or get it to that 10 to 13% where we can move it comfortably into our operating budget. So a good rule of thumb is that debt should be paid back or mostly paid back with 2 of these 3-year campaigns. So if we look at that and just quickly look at a scenario, we've got my church is in First PC Anywhere, not First PC Somewhere. That's a different one that Robert was referring to. They have a pledges to operating of $300,000. And so this congregation is trying to consider whether they can afford $1 million project to renovate their fellowship hall. And they've already been transparent with the congregation, and they're willing to do 2 capital campaigns. So how long is it going to take to pay off this loan? Well, we already said that with $300,000 in pledges, a good capital campaign could be 2 to 2.5 times. So if we assume they're doing a 2.5 times their operating first capital campaign, they're going to get $750,000. So if we assume for this scenario that the capital campaign starting exactly when the project renovation is going to start, you're going to have 1 year of that capital campaign that's going on when your project work is being done. So you're going to have those funds, 1 year of those funds coming in that you can put directly towards the project and lower the loan amount you need. So you don't need to borrow a whole $1 million. You can bring that loan amount, as you see there, to $724,000, because we're going to collect $276,000 in that first year. Okay, so that's the amount that we're going to collect of that 3-year campaign in the first year at 92%. And we say 92% simply because even though people pledge to a campaign, sometimes they have changes in their life and they're unable to honor that. So typically what we see is about 92% collection rate. Okay, so we're through the renovation, we're through the first year of the campaign. We're going to move into the second capital campaign. And typically what we see is the results of that are 75% of what your first campaign is. So they're going to get that amount, about $562,500. All that's going to go to principal payment and debt service, or those loan payments. So if we look at this, they're going to pay off this debt. Well, they're going to have about $30,000 left at the end of 3 years that they can move that into their operating and have completed their $1 million project with a loan paid off in 6 years. So that's a good size project, all other things being equal, for a church of this size with that operating budget. So we've talked a lot about taking on new debt, but regarding management of existing debt, sometimes circumstances with all the planning, all the due diligence we've done, circumstances change within the life of the church, and beyond the life or beyond the control of the congregation, a pastor leaves, church splits, we have pandemics. This can force the congregation into an unexpected financial situation from where we originally thought we would be. So what we want to do first is determine what's changed in the financial life of the church since that debt was originally taken out or originated. So first, has the church increased the operating budget too much, which is easily done when we've had a new project where maybe the project's expanded ministry, and then we realize we need new staff for this new ministry. So that's easy, can happen after a project. So just be aware of that. Or on the other side, have our church pledges gone down? Have we seen some members leave? So on both sides of those, obviously they can have an impact on your church finances. But here's the key one. Did the church do that second capital campaign they said they would do? Many times when we talk to churches that are challenged with managing their debt, it's because they didn't follow through on that original plan that they'd all committed to do that second capital campaign. And what that sometimes results in is that they then, are making unbudgeted draws from their other assets to pay that debt service. So if there are unbudgeted draws that go beyond their spending formula they may have in place, this can pretty quickly lead to unsustainability and have some pretty long-term impact. So what are some things that we can do when we're caught in that change in our financial position with regards to debt? And one thing that we can suggest is a debt reduction campaign. So debt reduction campaigns are typically more challenging. We've removed ourselves there's been a long time passing since the original project has been done, perhaps. And so the further along that you get from the excitement of that project, the more challenging it is to raise those dollars to pay down that debt. So one thing you can do if you're planning a debt reduction campaign is to consider adding a mission component to the project or a small project. So perhaps 5% of all donations to the capital campaign are set aside for a new ministry that can generate that enthusiasm or excitement again. Another thing you can do is consider refinancing. So this can be very helpful to improve cash flow. If you refinance your debt over a longer period, that means your monthly payments are going to be lower. And so that can be very helpful for those churches that are feeling some financial burden with their current debt. But we want to make sure that we're finding an appropriate balance between managing that debt service that we're talking about, that monthly payment, and managing the total debt. So yes, we may get some short-term relief with those lower monthly payments, but we may be burdening the congregation with debt far longer than was originally anticipated. If that loan was supposed to be a 10-year, and now we're looking at debt that's going out 20 to 30 years. So we really want to just make sure that we've got that appropriate balance of managing that debt service and managing that debt. So that's really, in a very brief nugget, looking at the one of the key liabilities on your balance sheet of being the debt that you either have or plan to take on in the future. We're going to move to that other side of the balance sheet now and start talking about some assets. And one quick question. I've seen a lot in the Q&A that people want these slide presentations. Yes, they will be made available to you. So I've probably answered 10 of those questions just with saying that. So we have with us from New Covenant Trust Company, Brad Masters and James Carey. Brad has served the foundation and NCTC, which is an acronym for the New Covenant Trust Company, for 11 years and leads NCTC's client engagement efforts. The engagement team consists of faithful and dedicated financial and investment management professionals who seek to provide investment management and financial planning services to churches, mid-councils, individuals, and other faith-based institutions across our country. He is joined with James Carey, who is the Director of Investments for the New Covenant Trust Company. James leads the NCTC's portfolio management and investment strategy functions and chairs the Trust Investment Committee. He is a CFA charter holder and a certified financial planner professional who is passionate about serving churches, individuals, and ministries that NCTC is blessed to serve. So with that, I welcome, I think, Brad, you're teeing it off, right?
Yes, thanks, Claire. Again, good afternoon, good morning, everyone. Just to offer you a brief overview or an introduction to the New Covenant Trust Company before handing it over to James. We want you to know a little bit more about who we are. And just first and foremost, we want you to know that it is our call, that we exist to serve the church. We're called to be your partner in ministry. We seek to empower and support local churches, mid-councils, faith-based institutions, and church members by creating and sustaining healthy and vibrant ministries just through the faithful stewardship of your investments. We are a wholly owned subsidiary of the Presbyterian Church Foundation. We're based with the foundation in Jeffersonville, Indiana, and serve clients, primarily churches throughout and across the nation. New Covenant Trust Company is a limited purpose national bank. We're chartered and regulated at the federal level by the Office of the Comptroller of the Currency, also known as the OCC. Limited purpose charter simply means that we focus more on providing investment management services and trust services rather than issuing loans and lines of credit, again, like our friends from the investment loan program. We're a team of 17 faithful and gifted individuals who maintain all of the industry standard levels of education, credentials, years of experience, who with a spirit of servant leadership and industry level expertise seek to deliver resources such as vision and strategy development, investment advice, policy development, portfolio management, and specifically values-based investing strategies, which are in alignment with your unique goals, objectives, and values. We do also offer charitable trust services, endowment management, financial planning, which also includes charitable gift and estate planning. And then as mentioned earlier by Robert, along with the foundation, we are able to support stewardship efforts as well as major and planned gift campaigns. We are also driven by our shared faith and values, the integrity of the PCUSA. We focus every day on serving the church, taking excellent care of each of our clients, no matter the size of their account. And certainly just in closing here, because we exist to serve, we ask that you let us know how we can serve you. And I'll come back at the end with some closing comments. But again, it's a privilege to be here with you all. And I'd like to go ahead and turn it over to James Carey, the Director of Investments for the New Covenant Trust Company.
Great. Well, thank you, Brad. And again, good afternoon, everyone. Thank you for your attendance, for your participation. Seems like we really struck a nerve here, given the number of registrations and the number of people in attendance here, over 250 on the call right now. So really glad that we can offer you something that's useful and of help to you. And we're going to jump right in, given the time, into our asset management discussion. So as we discussed talking about asset management, this asset side of your balance sheet, we really want to just start with a sort of foundational evidence-based fact as it relates to asset management. And that is, it is the asset allocation, your mix between stocks, bonds, and cash on your balance sheet. That is what drives over 90% of your returns. Even though it's more exciting and interesting to talk about picking stocks, picking funds, timing the market at your dinner parties and things like that, that really accounts for less than 10%. It explains less than 10% of your long-term returns over time. It really is this asset allocation that drives most of your returns. And so because of that, we really focus on this asset allocation, most of all, putting in the time, putting in the energy, putting in the focus on these decisions to really drive most of your outcome, to drive most of your success as an asset allocator, really focusing on this piece. So how can you be a wise and prudent asset allocator? Well, that question really comes down to a function of two questions. One of them is, how soon do you need your money? How soon do you need your assets? And what sort of objectives and goals do you have for your assets? So we have some different time horizons, some different durations for your assets listed here left to right. And we also have sort of long-term rough expected returns based on historical data for those assets, along with the risk of those assets. What's sort of the worst case scenario for a 12-month period with some of these asset allocations in terms of downside risk? So do you need your assets immediately? Is this earmarked to make payroll next Tuesday? Is this something that your treasurer needs to pay the bills, this Sunday? Well, that should really be in a bank checking, a bank savings account that is stable value, will not fluctuate. And, you're not going to earn anything necessarily on it or earn much on it, but it's doing what it needs to do. It has a stable value. It's there and it's liquid when you need it. Is it something that you need soon? So maybe this is funding a project, a near-term project. Maybe this is funding your operating reserves, which is absolutely something that we really recommend investors and churches have, is this rainy day fund, these reserves. These are conservative income, maybe money market, CDs, bonds. And again, you're getting relatively low return expectations for these types of conservative income instruments. But in exchange for that, you have very low volatility. Really, as long as the bonds pay you back, as long as the bank doesn't fail, you should be in a stable value scenario with these conservative income instruments. Maybe you need the funds a little later. These are assets that are for capital projects, 5 years, 6 years. It's funny that Jim mentioned both the boiler and the roof, which is something that we hear about a lot at New Covenant Trust Company from churches. Maybe the roof has 5 years left, you're saving for that, or any other specific savings in this sort of medium-term range. Well, now maybe you get a little more balance. Maybe you begin to introduce some equity exposure if you have 5, 6 years to the portfolio. And what that's really trying to do is keep pace with inflation. We've seen a lot of projects that started in 2019 and suddenly the price of lumber, the price of construction, the price of labor is much different when you get around to this project. So if you have that 5, 6, 7 year sort of time horizon, some equity allocation is going to help you keep pace with inflation. And then finally, those assets that are earmarked for much later, 7, 10 plus years. And we've seen endowments that are 50, 60, 100 years old. Now you're really looking at more of the balanced growth asset allocation, 50 to 80% stocks. These are endowments, both restricted and unrestricted, that Robert talked about, or any other long-term savings. And you do have, much higher returns for these types of allocations, but it is in exchange for assuming more risk, more volatility in markets. So as an asset allocator, to be optimal, to be efficient, you don't want everything, something that's earmarked for 10 years from now, to be in this bucket necessarily, earning zero returns, being eroded by inflation. If you have an opportunity to let that be invested for 10 years, you don't want to leave returns on the table necessarily. If you can double your talents, that's maybe what you can and should do as a steward. At the same time, if you do need something immediately, you don't want to look at these returns and say, oh, these high returns look great. If you need it in a year, you don't want it to be here where it can go down by 20, 25, 30%. So asset allocation is really just optimizing this sort of matrix so that you can maximize the returns that you can have while maintaining the safety and liquidity that you need based on your goals. So we'll go through each of these quickly, and I'm conscious of time. But again, just in this immediate needs bucket, this again is your bills, your payroll, your immediate spending. This should be in bank checkings and savings. The benefit of this is liquidity, safety, and the stability of that value. But you do have risks here. People sometimes think that risks are only stock market risks. Stock markets can go down, but you also have inflation risk as an asset owner. Inflation risk means if you do just set it in a checking account for 10 years, it can now purchase fewer goods and services, probably much less than it could 10 years ago. So that inflation eroding your purchasing power is a risk that you want to be aware of and not necessarily have everything if it's not needed in this 0 to 1 year time horizon in this immediate term bucket. Short-term needs. So anything, now we're looking at 6 months to 3 years. These are your operating reserves, those near-term projects. Now you're looking at things like certificates of deposit, money markets, short-term bonds. You still have some level of safety, liquidity, and that stable value, but you do have a few other risks. Inflation risk is probably still there with these short-term securities. You've also got duration risk, which essentially just means if you have something that you need in a year, you don't want to buy a 3-year CD because if you have to sell that 3-year CD before it matures, you may be subject to some interest rate volatility if rates have moved. You may also have early termination penalties and things like that. So match your duration to when you need the money, and you should be able to avoid duration risk. You also have credit risk. So you want to be sure you're buying safe bonds, safe securities. We tend to look at AAA, AA, single A bonds or higher. You really want to be sure that that institution is going to pay you back for your CD or your bond. Ironically, we have the US Treasury here, sort of considered the world's safest security. There's obviously some consternation going on with that. We do think that'll eventually be resolved, but you want safe credits, and you want stable value for this short-term bucket. As we get out to that medium term, 3, 4, 5, 6, 7 years, again, these capital projects that may be coming up down the road, you can begin to get more to your conservative to balanced allocations, introducing some equity exposure to those portfolios, global stocks and stock mutual funds, bond and bond mutual funds. You may still be layering in those conservative short-term bonds, those CDs as well, because you do want this to be safe so that it's there in 4 or 5 years. But you are expecting to get a little more growth, seeking to keep pace with inflation, again, keeping that purchasing power of your savings. And you should expect some reduced volatility versus that balanced growth long-term mandate, since you are still relatively conservative. In this chart, you'll see kind of, the market's best years and worst years across these allocations. And, at 80% stocks, you can go down 35%, which is absolutely what you don't want in the middle of a medium-term sort of project. But, if you have, a little bit of volatility and time to recover, in exchange for some higher returns, in exchange for keeping pace with inflation, you can pick up a bit more risk in this medium-term time horizon. You are, of course, picking up market risk, which simply means that the stock market can go up and down. And we'll see that especially on the next slide. So now our long-term needs, 7 to 10 plus years. These are your endowments, both restricted and unrestricted, and other long-term sort of unrestricted savings. Robert did a good job mentioning, the various restrictions that you may have on your endowments. That's important to be aware of and know. But here you're really looking at, again, 50 to 80% stocks typically. This is the bucket that you don't need in 1 year, you don't need in 5 years. This can be invested for 10 plus years. You're looking at this balanced growth allocation, and you can expect growth that is greater than inflation, growth that supports spending rates. So maybe your endowment is providing a 4.5% spending rate to the operating budget or to other mission, and growth for future generations. We all hope that we can leave behind a healthy endowment, an endowment that is, grown over the generations. So you do have market risk here, and here you really see it, I think. This is the US market since 1926. The average return has been 10.5%, but only in 7 years out of 96 has the return been between 8.5 and 12.5. Market returns have been up 40, up 50, down 40, down 20, up 40, and that's how the stock market tends to be. So the average return is 10.5, but you almost never get 10.5. You get these, much higher and much lower ranges. And so it's important that you're aware of investor risk, which essentially just means that sometimes as human beings, we're our worst enemies as investors, and we sell at the worst time and we buy at the worst time. So really being aware of this volatility, knowing that you can put it away for 10 years and remain disciplined as an investor is really important for this bucket. So in conclusion, just a couple of best practices as an asset allocator, as an asset manager for this side of your balance sheet. First of all, start with your goals, objectives, and timelines for these assets. Match those assets, return goals and timelines with the appropriate asset allocation approach, sort of like we looked at that table earlier. Really important, document each account's purpose, goal, and timeline in a written investment policy statement. So this is really important for, future sessions, future committees, even for your service providers, really to understand what the goals are for this, what the needs are, what the specific constraints you have for these assets, all documented and written in an IPS. Seek broadly diversified and balanced investment approaches. We don't want all of our eggs in one single basket. We don't want to bet the house on technology stocks or bank stocks, as we've seen recently. We don't want to have just 10 stocks and one of them is a bank that's in a lot of trouble. We want to have thousands of stocks across sectors, across industries, across geographies, to really be a balanced and diversified investor. Remain conscious of fees. There's not a lot of things we can control as investors. We can't control the market. We can't control the Fed. We can't control interest rates. but we can remain conscious and control the fees and the expenses that we have in our investment portfolios and make sure that we're really getting value for what we are paying for. Remain disciplined in your investment plan through market volatility. We talked about that investor risk, which is a well-documented phenomenon where investors do worse than their investments because they buy and sell at really bad times. So remain disciplined in your investment, stick to your plan. And lastly, seek professional expertise as appropriate or needed. I think this is so critical. We talked about how important asset allocation is to the long-term sort of sustainability and health of your balance sheet. If you need a professional that you trust, it's absolutely recommended. It can absolutely be beneficial and valuable to you and to your church. So if we can help, we'd love to, but if anybody you trust can help, that can be advised as appropriate. So with that, I'll say thank you. I am looking forward to your questions. Really appreciate the participation. And I'll kick it back to Brad to tell you how you can reach us at New Covenant Trust Company if we can ever help.
Yeah, so thank you, James. Again, really powerful, meaningful, and impactful when agencies lean in together with the resources that we have to serve the church that is all of you together. So to carry forward the investment related conversation or perhaps the stewardship conversation as well, we wanted to give you the contact information for the trust company as well as the foundation there directly. Robert mentioned earlier with the big map that we have, it's always a good idea to start with your foundation ministry relations officer to kickstart the dialogue, and then from there pull in appropriate resources throughout the journey. So leaving you with our contact information there. Claire, I think it's a time for Q&A.
It is. Thank you. Well, and thanks to all our presenters. And I think we're all available. We have some questions, both that we received ahead of time and some new ones that have come in today. I think Greg Russo, who is President CEO of New Covenant Trust Company, is here to respond to questions too. So let's kick it off with some questions. So I think this one, since we just came off of talking about investments, someone's asking, what are safe investments for less than 1 year? Should we have a ladder approach, purchase 3 months, 6 months, 9 months? What would you suggest?
Yeah, so I can take that. Really, I would focus on credit risk if you're under 1 year. You obviously want to focus on duration risk as well and make sure you're not buying a 2-year CD if you need it in 1 year. But if you're looking at 1 year or less, I would consider treasuries, treasury bills, and CDs. And laddering is perfectly fine. You could also consider a money market as long as that money market is competitive. For example, at NCTC, our money market is paying above 4% currently. So you can consider each of those as long as they're safe and that you're matching your duration to when you need it. Each of those we would consider safe investments for 1 year and in.
Thanks, James. We have a question about when is it appropriate to set up an endowment? Robert, do you want to give that one a go?
I think it's always appropriate to set up an endowment anytime. I think it's a missed opportunity in most congregations to not have an endowment. And endowments typically are meant to be funded from planned gifts, wills, bequests to churches, and that's a missed opportunity in many churches of a way that your members can leave their legacy to the church. So it's a stewardship issue on one side. There are assets that good Presbyterians can and will leave to your church if you give them a vehicle to which they can give to, and if you start to ask them to leave their legacy that way. But on the other side, as we go forward in the life of the church, it's becoming more and more important for churches to have some other revenue streams. And not only count on just giving to meet their budget. So, we're seeing more and more where a church needs 5, 10, maybe even 15% of their revenue being income that is coming from an investment or an endowment type vehicle. So I think it's important to financial viability in the future, but it's also important to individual stewardship.
Thanks, Robert. Here's a question. When is it best to borrow for major property or building grounds maintenance additions versus using funds already on hand? Jim, do you want to take a crack at that one?
Certainly. Thank you, Claire. Great question. You need to look at that, or should look at that in a broad fashion. That is that how much do you have in the reserves? How much do you have in the unrestricted reserves? And how much do you want to have in those unrestricted reserves is one thing that you'd want to look at to make sure that you have that level that you want to maintain long-term. Secondly, what sort of return are you getting? Is it at a time that the investments is it a good timing to liquidate some of those and use them to put in? So look at what the return is on the investments. Look at your similar to what was just stated as far as the long-term approach on investments. Make sure that you are taking that into consideration, because once those are gone, they don't come back. And so, or at least don't come back easily once they're spent. So the timing would depend on both of those areas. How much do you have in reserves and how much you need, and what does your investment portfolio look like, and how is it performing?
Thanks. Another question, is there a recommended annual percentage draw from an endowment to use for fund for church purposes, operating or capital? Greg, is that something you'd like to respond to?
Yes, I can, Claire. Thank you. Very good question. It's great to be with everyone. It really, there is a recommended draw, but it's heavily dependent on your asset allocation and what capital market assumptions we have for your asset allocation. So if it's an endowment fund that is typically 60 or 70% equities, the balance fixed income and cash, we'll see anything from a 3.5% to 4.5% range, somewhere in there. But really, it depends again on the level of risk that a congregation is willing to take, time frame, those sorts of things, before we really lock into what the appropriate distribution rate is. But that's something we can analyze and really help congregations discern.
Thanks, Greg.
Thanks.
We have some questions that they're very specific, that we may all these questions that we don't get to, we will get answered to you offline. And we are going to make all of the presentations, as I mentioned, and I think this is available as it's recording to those that signed up after as well. But we have another question here. What about leasing parts or all of your building to another entity? Leasing the fellowship hall to a pop-up community medical clinic. So any thoughts, concerns with leasing to an entity that's outside of the church? Jim, do you want to maybe?
Sure. Yeah, I'd be happy to. That's common among our churches these days. As several of the churches have more space than they need currently. So it's something that's done at least two things, and others might have some comment as well. One thing that you want to check is just the liability situation. Make sure of what sort of coverage you have and any activity that goes on within that rented space. What exposure might you have? I check with your insurance provider to make sure that you're in a good place. Also make sure that you know what their insurance coverage is, what they're carrying, and share that with your insurance person to make sure that you're well covered. The other item that you want to certainly take into consideration is depending on the dollar amount, the space, is there a mortgage on the property? You need to look in at the possibility of unrelated business income. And is that a taxable situation for the church? So you would need to speak with either a tax professional or perhaps your accountant and cover that to make sure you understand that either there is none, or if there is, what that might be. Those are two things that I would say look at, but it is something that is commonly done. I don't know if anyone else has anything to add to that.
Yeah, I'd like to add two things, if that's all right. One, many presbyteries have part of their standing rules that if you're going to lease part of your building, particularly the worship space of your building, that the presbytery has to be a part of that that discussion. So if you're going to begin a lease agreement, particularly a long-term lease agreement, you need to be in conversation with your presbytery leadership about that and what rules and policies your presbytery has about that. But two, yes, you should, if you have the opportunity to leverage your building by earning revenue through renting and leasing, that is becoming more and more important for financial viability for a church. So I would encourage you to take the steps you need in order to do it and do it prudently, but that revenue stream can allow you to continue to do more and more ministry.
Thanks. We have a question. Are annuities a sound investment for churches? Sounds like a James or Brad question.
Yeah, so typically annuities as a life insurance product are insuring human beings against living too long, similar to how life insurance insures you against living not as long. So they tend to not be used for institutional investments. There are sort of different, if you're looking for a steady stream of income, or if you're looking for a high level of certainty around your income, there are other opportunities and avenues you can look at, including around sort of that endowment conversation. But an annuity itself from a life insurance provider is not typically used as a church investment.
Thanks, James. We have a question. There's an interesting one. Is a donor, the original donor, can the original donor override the restrictions she made on a fund? So if the donor made the fund years and years ago, does that donor have the authority to override those restrictions?
Hey, Claire, it's Greg. That is really fact specific according to states and state law. So, a lot of states, but not all, have adopted UPMIFA, the Uniform Prudent Management of Institutional Funds Act, which governs endowment funds. So that's really a question that is going to be state specific. I will say that that can be challenging in a lot of cases, but consult local state law or an advisor that could help navigate that. And even if that's the case, some churches, some nonprofits are willing to do it if it's permissible, and others still will not be. So it's something really to talk about. There's not a definitive answer on that.
Thanks, Greg. A question, what is the recommendation for reviewing, updating fixed asset balances?
I guess I could take that since that probably came from my section of this. So again, I think your fixed assets really only, the value of them really only need to be on your balance sheet if you've got debt on them. And so we're really putting them on the balance sheet in order to be able to track the debt service that we have on it as we pay that debt service down. So there really is not much reason as a church to update or change the value of your fixed asset. There's no need to do depreciation as a church for your fixed asset. So there's really no need to make a change to it unless, and somebody did ask this question and we responded in the Q&A function, unless there is new debt that is taken out that is based on a higher or even lower value of appraisal of that fixed asset. That would be the only time that you may want to adjust the value of your fixed asset.
Okay, thanks. I think this not necessarily a question, but maybe any advice that you could give to this person what to be done when previous to the arrival of this person, the church almost folded, nearly all monies into the general budget. There was no endowment. Restricted gifts are noted as an afterthought, not on the balance sheet, more as a Word document. They have a few small CDs, one money market. They draw from money market to make monthly overages when necessary. Any advice?
Claire, this is Greg again. I would recommend they reach out to their Presbyterian Foundation Ministry Relations Officer. I think that person can really help them get started with understanding, you know, their financial position and the best way to structure things going forward.
Good answer. Mm-hmm. What low risk options are available for us to invest in right now?
Well, low risk, you know, be aware of your duration because you'll have to pick a term, but we really like CDs here. You know, brokered CDs are well into the 5s, above 4.5% at many institutions. So if you're looking for something 2-3 years and in, we really do like CDs under the FDIC insured limit. Make sure you're matching your duration to when you need it, but CDs are attractive for those needs. For once, it's been a while since they have been, but right here they really are.
I'll piggyback on that in terms of, you know, the investment portion of our name is our term notes similar to CDs that you'd get at a local bank. And so we use those funds only to fund our church loans. So if you are looking for a socially responsible investment, so you know exactly how those dollars are being used, you might want to look into our term notes that we have available here that are, you can choose your term from a 6 months up to 60 months. So we'd be happy to give you those, our rate sheet on those as well. Okay, let's see what's going on in the questions here. I think this is maybe for you specific, Robert. On the balance sheet, there is a line for total liabilities and equity. Why are these two added together?
Well, so on your balance sheet, you've got the two sides, right? So the top of your sheet is your assets. It's all of the things that you own. And so what you're trying to do on a balance sheet is then show what do those things that you owe, what are the obligations that you have for those things. And so liabilities are some of the obligations that you have to pay out that you haven't paid out yet. And so that's the liability portion of it. And then what I believe you referenced equity, and that's how we would talk about the net assets in for-profit accounting. And nonprofit accounting, we talk about the net assets and the fund balances. But they're the same concept. It's what are all these things that we own, all these assets that we have at the top, what are they for? And so we break out those things again. So it gives us a whole picture of what do we owe on the things that we own. So what are our liabilities that we owe out? And then of the things that are left, whatever is it's restricted and we can't do anything with it except what it says it's restricted for. So that's where we're trying to get to with the balance sheet and the balance of the top and the bottom. I'm not sure I explained that very well, but you know, reach out to me. I'd be happy to have more of a conversation with you directly about that one if you want to dig in a little bit.
Okay. We have someone asking, what is the difference between a trust and an endowment?
Yeah, Claire, I can take that. As long as I have a couple hours to talk about it, I can do it. It's a lengthy response. A trust, I'll start with a trust. A trust is a separate legal entity. Apart from a congregation, apart from a foundation or a corporation, it's a separate legal entity where assets are placed in a trust, a trustee is named, and the trustee is most likely a third party, maybe New Covenant Trust Company, who administers that trust according to the trust instrument. So that is something that is defined in the instrument, and the trustee is required to act in the best interest of those that benefit from the trust, and it is determined by the trust instrument. An endowment is actually an asset, probably an asset of like a congregation. In a congregation, the session, the congregation can determine or restrict investments that it has and call them an endowment and say, we're only going to use these assets as an endowment fund where we are going to restrict principal, so principal is never spent, and just have a distribution policy. So an endowment fund is still titled to a corporation, an entity, a church. They can adjust spending policy. They can adjust asset allocation if they so choose over time. And that would be what I would call a board designated endowment. The other type of endowment is a donor designated endowment, where a donor makes a gift to maybe a congregation or to the Presbyterian Foundation, and then requires that that gift be held in perpetuity and then only income be spent. So they're two very different vehicles, a trust and an endowment fund. So I know that's confusing. If I can provide any more clarity, just reach out to me and let me know.
Thanks, Greg.
Sure.
Jim, we have someone asking if the church has any financial support for flood debts that were not covered by insurance. I think we might.
Any financial support?
Yes.
Yeah.
For any debts that were not covered by insurance.
Right. Yeah. So if it's a situation where there's been a type of, well, first of all, I should say that we've got a very specific, what we call one of our special purpose loans, that if it's in an area that is designated as a disaster area, either by the state or nationally, that we've got something called the disaster relief loan. And that is offered at a significantly discounted interest rates for the life of the loan. And it has some other special features also that will help your cash flow in the early days. If it is not in a designated area, we still can provide lending that is not covered by insurance to improve the property, renovate the property, and that would be under our normal type of lending, as long as it is for a capital purpose. It's, you know, the building itself within it, we can provide that type of lending. Claire, I think, did that address the question?
Yes, I think so. Yeah.
Okay.
And while I have you, there's one more. If fixed assets are held in trust by the presbytery, would it ever be proper to show their value on a balance sheet?
Yeah. I'm sorry, did you want me to do that? Okay.
Sure.
So could you repeat that again? Trust, if the trust is?
If fixed assets like their building are held in trust by the presbytery, would be ever proper to show their value on a balance sheet?
If the fixed assets of the building are held in trust.
Tag in.
Gosh, that might be a Robert question.
Yeah, I'm happy to tag in on this one. So I think the question. I think the question here is about the property trust clause, right? So and that's this idea that all property is held by the local congregation for the denomination in trust through the presbytery. That's the concept. And so the local congregation actually holds title to their asset. The trust clause is what tells us in our polity that the local congregation cannot do away with that property without going through the presbytery. So it is actually an asset of the local congregation that is being held in trust by the denomination through the presbytery. So it is an asset that belongs to a local congregation. Just our polity prevents you from selling it or disposing of it without participation from your presbytery.
Or collateralizing it. So if you are using your property as collateral against your loan, or if you then that requires presbytery approval to do so.
Correct.
I think we're getting to the end of these questions. I don't see any open questions in our chat online. And I think we've mostly answered these on here. So if we missed any, we will certainly reach out. We do have your email and get you those answers. I think you have all of our contact information if you'd like to reach out to us directly about a specific question for your congregation or personal. We will make this available. Nathan, do you know how that link will be sent out for them to watch it again, or for the recorded version?
I'm not exactly sure what medium that's going to be distributed in, but it will come out in the next week.
Okay. All right.
Check your
and thank you. So all this information that you've received today will be available to you. And again, if you have any other questions, or you're looking to partner with either the foundation, the NCTC, or with the investment and loan program, we encourage you to be in contact with us, and we appreciate you spending the last hour and a half with us.
Thanks, everyone.
Thanks
Thank you
again to all the presenters.
Thank you.
So
Bye.
take care, everyone.
Bye.
Hi, everyone.
Thank you.
Thanks.